there, traders and investors. Bennett Tyndall with tradinganalysis.com. Today is Thursday, December 10th, 2020, and this is your weekly Thursday night public market update. So traders, taking a look at what transpired in the markets yesterday, we saw a rather sharp kind of directional corrective pullback, which it really wasn't all that surprising when you take a look at the market through the lens of the Elliott wave theory, which if you follow our work at Trading Analysis, you'll know that's one of our preferred forms of technical analysis when used in combination with Fibonacci. So let's start it off by taking a look at the wave structure in the US dollar. Going back to the March 2020 high, we had projected an upside zone of resistance that we had anticipated rolling over into a directional 5-wave sequence. The rest is obviously pretty clear. As you can see here, we have moved significantly lower from the March highs, and we're approaching a zone of downside support, which could prove to be a little bit interesting and troublesome for U.S. equities. So taking a look at this structure, if you'll recall, we had this wave 2 lined up for you guys. We then projected the wave 3 into our 161.8% extension of wave number 1. That is spot on where wave 3 came to completion. Wave number 4 was then a little directional zigzag to the tune of a 38% retracement of the wave 3. And we're now in an extended 5th wave position, which I'm noticing has a lot of confluence in terms of wave structure interpretation to that of not only crude oil, believe it or not, but the leading sectors and indexes. So as you can see here, and based on our Elliott wave interpretation of the dollar, we view this most recent move higher as a wave 4 position occupying a higher degree wave number 3. So in a motive impulsive structure, on the time frame that you're tracking it, you need to have one of the waves extended, one of the motive waves, 1, 3, or 5, being extended and having a nice discernible 5-wave structure of its own. In this instance, that's our wave number 3 of wave 5. And you'll notice this move up in 4 has resistance, which suggests a new low. Then we see a counter trend pullback, and then we get another low, at which point, even if our longer term bearish counts on the dollar do materialize, we should at the very least be in store for some sort of a 3-wave counter trend rally. Now, taking a look at wave structure in crude oil, you'll notice, which by the way, we had an absolute blast forecasting and calling that breakdown. We're now looking at this upside movement on the 1-hour chart going, well, that's interesting. It's looking a lot like what we're seeing in some of our major indexes and leading sectors. That being, we have 3, 4, another move up in 5 to create 3, counter trend pullback, then move higher in wave 5, at which point we will complete a 5-wave structure following our beautiful ABC measured move corrective pullback, which should then set us up for some sort of a counter trend wave 2 move to the downside. Okay, now let's switch gears. Let's take a look at the S&P. As you know, we've been bullish. We've been watching this expanding volatility pattern on the weekly and daily time frames, and we do think we're gearing up to move out of this zone. Unfortunately, looking at the market through the lens of the Elliott wave theory, we see the possibility for a larger corrective pullback to take shape sometime early next year. I'm talking middle to end of January, maybe even late February. But we do see a larger move on the horizon, and it's something to be considering in advance. Be thinking about how you could take advantage of it when it takes place. The wave 2 pullback, being that it is a wave 2 position, is going to take you to a variety of retracement levels. So let's get off the weekly, let's get down to the daily chart, and let's focus in on price action post September 2nd high. So I'm going to drop a circle on that. We're going to get off the daily. We're getting down to the 1-hour chart, and let's focus in on everything that's happened since the Pfizer news came out on November 9th in the market. So zooming in just a little bit, let me adjust the scale here for you guys. What we have is a nice 5-wave move into a 3-wave pullback. We then move up in a 5-wave fashion and a sideways 3-wave correction to the tune of about 61.8%. We then have a 5-wave move in 1, 3-wave pullback in 2, to about a 61% retracement. Then, off the 1 hour and down to the 30-minute charts, you'll notice what we end up with is an acceleration gap, which is very common in the 3rd wave position. And then we complete into yesterday's high just shy of the 161.8% extension of wave number 1. Wave number 1 led to a kind of sideways wave 2, which based on the guideline of alternation suggests that we were going to see a sharp directional 4th wave. The wave 4 found support at a 38% retracement of the wave number 3 and just shy of being equal to wave number 1. Now, in the event we do break 36.27, we do have some smaller time frame structures and counts which would entertain still continuation. But if we do see a move south of 36.27.17, I will get a little bit more concerned. Now, this is what I see remaining for this subdivision of the higher degree trend. A move up in 5 of 3, a wave 4 pullback, and a move up in 5. What did we just look at in the US dollar? In the dollar wave count, we're looking for one more new low, counter trend rally, one more new low. New high, counter trend rally, new high. Then we've got a wave 2 to likely contend with. Now let's take a look at why I think we do still go higher from here. And if we continue to fade lower, I'm absolutely fine with that. But based on the current wave structure, I do think that this was just an initial shakeout prior to resolving to the upside. Looking at the NDX from the November 2nd high into the November 9th high, we get a sharp wave 2 pullback to about a 50% retracement. We then print 5 up, 3 down, another 5-wave subdivision in orange wave 3. Where did orange wave 3 stop? Just shy of 161.8% extension compared to wave 1. And inside of orange number 3, wave 5 was equal to wave 1 of the same degree. The support came into place between a 50 and 38% retracement. This suggests we resolve higher and has the same interpretation of the S&P. That being a larger wave 2 pullback will then be in store. Looking at the SMH has been a fantastic, beautiful looking wave count. This has been a leading indicator out of our wave 4 38% triangle and off the daily down to the 195-minute chart. 5 up into November 9th, 50% retracement. Another 1 sideways 2, 5-wave subdivision of 3 into your 1618. Wave 4 today found support at a 38% retracement. You have the guideline of alternation at work. You have very common and key fib levels. You have confluence of your wave structure counts across multiple leading sectors and indexes. I'm going to stick behind this market, and I think we push higher. Communication sector ETF, kind of a new spin-off back in 2018. Well, we're looking at a very similar interpretation down here on the 195-minute half-day chart. That is 5 waves into November 9th, wave 2 pullback, up in 1. This is the directional wave 2 for communications. Communications completes 5 waves up into December 3rd. Look at this, 161.8% of time elapsed in wave number 1, just shy of 161.8% of the magnitude of wave number 1. Then we pull back in wave number 4, found support at a 38% retracement, also demonstrating equality to wave 2 counterpart. This suggests we go higher. Complete 3, 4, move higher in 5. Then the 5-wave subdivision off the March low will have come to completion. And that's when I'll be looking for possible downside trades, while at the exact same time looking to take advantage of corrective pullbacks for longer term reasons. Finally, let's wrap it up by taking a look at the XLK Sector Spider ETF for technology. What did we do? 5 up into November 9th, wave 2 pullback, 5 up, sideways wave 2, about a 61% retracement in wave 2 there. 5-wave subdivision in green wave 3. Green wave 3 took you to 161.8% of green number 1. And then yesterday's pullback found support right at equality to wave number 2 of the same degree, also supported based on the guideline of alternation. Those of you who are unfamiliar with the guideline of alternation, it suggests corrective moves of the same degree will often alternate corrective patterns. So typically the roles are reversed. Generally you see the sharp directional correction in the wave 2 position and the sideways correction in the wave 4. In this instance we had the sideways correction in wave 2, directional correction in wave number 4. That is it for this evening's video update. If you enjoy the content, check us out at tradinganalysis.com. You can also go to Todd Gordon's YouTube channel every Wednesday at 8:45 Eastern in the morning. We host our TA Live Wednesday live stream. As a matter of fact, we just had a fantastic guest on yesterday. It was a whole lot of fun. Be sure to check that out. All right. Thank you for tuning in. We'll catch you on next week for Tuesday evening's video update. See you then.